Good morning, and thank you for standing by. Welcome to the AFS Best Practices Leadership Council webinar. Our topic today is credit trends in commercial lending. This webinar will be approximately an hour long, and before we get started, there are just a few housekeeping items. We are recording today's session, so all lines have been muted. We do encourage questions. You can use the Q&A feature to ask questions, and we'll leave some time at the end to answer questions. Tomorrow, you will receive an email with a link to listen or download the presentation. Thank you for joining us today. And I would like to introduce Bridget Polishine, CEO of the IIB. Bridget?
Thank you, Renee. Good morning, everyone. I'd like to welcome you to our webinar, Credit Trends in Commercial Lending, presented by AFS, a gold level associate member of the IIB. AFS is an industry leader in lending and risk management solutions, including their fully integrated lending system designed to process multiple portfolios. We appreciate the support of AFS. This webinar will provide an in-depth analysis of wholesale credit risk metrics and explore how fiscal stimulus and bank deferral and modification programs have affected credit quality in the lending market. Very timely, given Secretary Mnuchin and Chairman Powell's statements yesterday urging Congress to act on a fiscal stimulus bill. Kicking us off today is Sean Fell, Sales Director at AFS. Sean is responsible for relationship management and sales for financial institutions in the New York City area and Canada. Before joining AFS, Sean held a similar role with the ACBS division at Fidelity Information Systems. He has held numerous senior roles with leading banks, fintechs, and brokerage firms. Sean, we're looking forward to hearing from you and Tom today. Thank you.
Thanks very much, Bridget. AFS very much appreciates the opportunity to present to the IIB membership, the first in our series of webinars, as you mentioned, Credit Trends in Commercial Lending. Before we start, just a bit more about AFS and our solutions. We've been providing lending solutions for 50 years, so we're not new to this space. We're an independent niche provider focused solely on syndicated and commercial lending. Our solutions are multi-currency, cloud-based, mobile and digitally enabled, real-time and workflow-driven. Our solutions cover origination through servicing for all commercial lending lines of business, including syndications, SBL, SR, CRE, C&I, and probably some others that I've left out here. Today's topic is going to be presented by Tom Cronin. Tom looks after the care and feeding of the AFS Risk Analysis Service, or what we refer to as RAS. RAS allows banks to compare their own performance and credit quality to a select group of peers and the overall national commercial loan market. Tom has account management responsibilities for the AFS Business Intelligence products as well. These products are the AFS CCAR Data Quality Benchmarking and the AFS Pricing Dashboard. Tom has been with us for 30 years after a career in commercial and consumer banking. He has an MBA from the College of William & Mary and a bachelor's degree in history from Duquesne University. Thanks again for your time and interest, and over to you, Tom.
Thanks, Sean, and welcome to everybody today. Thank you for your time. If we can move to the next slide, here's what we're going to cover today. We'll start with our C&I results, move on to the CRE results, then we'll do a quick summary of what we saw and then open it up for questions. Now, on the next page, you'll see a little bit about the Risk Analysis Service. As Sean briefly described it, RAS started in the third quarter of 2003 as a result of the Basel II benchmarking requirements for risk rating loans. 8 banks got together with AFS and RMA and asked to put together some statistics. And in doing risk ratings, we also began to look at performance statistics as well as credit metrics, some of which you'll see here today. We're now at about $1 trillion in exposure, over 700,000 loans. And we have, as I said, since the third quarter, data back since the third quarter of 2003, and we now collect that data on a monthly basis. And basically what our banks do with this, it gives them the idea to check to see what they have and how's that doing against a select group of peers. So that's background on RAS. Let's move ahead and start looking at the data. So we're going to start with C&I, and just a quick note, C&I loans, as we describe them, are to private and public companies, usually with annual sales greater than $1 million. And these loans are manually underwritten and risk rated, and loans secured by owner-occupied real estate are included in included in C&I. So we're going to start with a look at loan performance, specifically the level of non-accruals and delinquencies. And if you focus on the blue line, which is the percent of loans 30 to 59 days past due, you see that there's been a lot of volatility over the past year, year and a half. And if you look at the sharp up and downs for 2020 and the M type design there, and you go back to the left to the 2008, 2009 time period, you see the same, you're experiencing the same shape of volatility as we saw in the recession, the same M patterns, if you would. But the levels today are service highs. For September 2020, we're back above 1%. Actually, for October 2020, we're back above 1%, something that did not happen in 08, 09. Now let's focus on the non-accruals, the red line. Unlike the frequent changes we're seeing with the delinquencies or the volatility in delinquencies, we're seeing the non-accrual rate on a steady rise. At the end of 2018, and again, we're focusing on the red line, the non-accrual level was at 0.69%. Since that period, non-accruals have increased almost every time period and now are above 1%, which is up almost 50% from late 2018. Now, we also saw a jump for loans 90 plus days past due, but in the next few pages, we're just going to focus on the increase in short-term delinquencies in non-accrual, since those are the heaviest. Next slide. So since we saw a big month-to-month increase in delinquencies, we're showing on this chart the 30 to 59-day delinquency level for this month, which is October, versus last month of September. And you can see the increase is widespread. 18 of the 24 NAICS sectors saw an increase in short-term delinquencies. And to highlight a few, we saw October levels 3 times September levels for the following industries and subsectors. 22, starting on the left, 22 utilities, with electric power generation as the subsector. 31 manufacturing for food and apparel manufacturing. 42 wholesale trade, and a little bit of a surprise here, the subsector with the highest level of delinquencies was groceries. 54 professional with computer system design. 55 management, which is holding companies, not banks. And 56 admin and waste management, with the highest level delinquencies being for armored car carriers. Now these 6, along with 45 retail, 48 transportation, 52 finance, and 72 accommodation, are all above the market average. Next slide, please. So now we're looking at short-term delinquency levels at the regional level. And there's a map at the end of this document that shows you how we've created each region, which states fall into each region. And a couple of thoughts here. First off, with the exception of the Western Midwest on the far right, we're seeing elevated levels for every region. Second, the Northeast continues to have the highest level of short-term delinquencies. And third, there was a huge spike in the Mid-Atlantic, and that region has gone from one of the best to now one of the worst. And last, the West has deteriorated from being average to now one of the worst also. Next slide, please. Now, during our, our bulletin review meeting earlier this month, this slide drew the most comments. Pardon me. The delinquency level for October is greater than the delinquency level for September for every loan size, no exceptions. And most notably, we saw delinquencies for participations and syndications double. It's also interesting to note that the delinquency level tends to increase with the loan size. Now, this is exactly opposite of what we've historically experienced and appears to be the result of the deferrals and stimulus money, which Bridget mentioned in her introduction. And now that those programs are ending, I wonder if we'll go back to the higher delinquencies for smaller loans. Now, this is something we're going to follow closely as time goes on. Next slide. Now we're going to take a look at non-accruals. And because those levels have been gradually increasing over time versus the rapid rise we saw for delinquencies, you'll notice that the time on these charts are different. It's October 20 versus December 19. So where we are today versus before the COVID virus impacts. This will give us a more complete picture of the overall impact of the business shutdowns due to COVID-19. And it's hard not to look at these charts and conclude three things right off. First of all, 21 mining, oil and gas on the left-hand side, the big red spike, has been by far impacted the most. Now in December 19, it had the highest level of non-accruals, but just slightly above agriculture. Now, as of August the 20th, it's almost 3 times higher than the nearest industry, which is 55 management. Outside of oil and gas, there are 4 other sectors that have been impacted. Not as much as oil and gas, but still showing significant impacts. They are 55 management, 56 admin, 71 arts, and under arts are the fitness centers, and then 72 accommodation, which is hotels and restaurants. And then lastly, many sectors have seen little or no change. Sectors such as 44 retail, which encompasses motor vehicle sales, transportation and warehousing, and 52 finance and insurance are among several industries that had near 0% non-accruals in December 19 and still are low when compared to oil and gas or arts or accommodation. But if you think back to our second chart that we showed today with the widespread increase in delinquencies, we wonder if this is about to change. Will we begin to see more sectors with higher level of non-accruals as the deferrals and the stimulus money runs out? Next page. Here's another look at the non-accruals by industry. And for this chart, we've looked at the percent non-accrual for each region, each industry, December 2019 versus October 2020, and show the sectors with the largest changes. This is just an easier view of what we showed on the previous slide. And as we had mentioned, mining, oil, and gas has increased the most, followed by management and admin support. And on the next slide, we're going to go a little deeper into some of these subsectors. So here we're taking one last look at non-accruals by industry, now at the 3-digit NAICS level. These 14 subsectors have the highest current non-occurring rates. All of them have non-accrual ratio north of 2% and top out at 19% for 213 support activities for mining. Many of these have already been mentioned in the previous slides. Industries such as oil and gas and passenger transportation and food, high human touch industries. But there are a few surprises here, such as forestry and textile mills. And I think these are not so much COVID-19 impacted subsectors as just historically risky lines of business, which is something you can see using the data in RAS. Next slide. So one last look at non-accruals, this time for deal sizes. And if you would, I think we went the wrong way. It should say size. There we go. So let's mentally split, if you would, split this chart into 2 groups. Deals $3 million and less, almost right in the middle of the chart. And then deals greater than 3 million in participations and syndications. So almost draw a line, if you would visually, mentally draw a line down the middle. And if you look at December 19, the blue column versus October 20, the red column, for the smaller loans, the loans up to 3 million, we really don't see much of a change. And I suspect if we plotted these as one size, the change would be minimal at best. Now let's look at the larger loans, the loans off to the right side. Each size grouping for these larger loans shows a sizable increase. And the largest increase is for participations and syndications, mirroring what we saw with delinquencies. And again, if you think back about what was done with the PPP loans, where most of those went, it was for the smaller loan sizes. So it just makes sense that those PPP loans have helped these smaller loan sizes stay current, whereas the larger loan sizes have had to, and larger companies have had to be on their own. All right, next slide. We're going to move on to look at risk ratings. And so this is what we call credit quality. And we're looking at the trend in detail of the percent criticized. And as we've mentioned on other webcasts, although I understand you probably have not been part of those, we take each bank's native borrower risk rating and map that into the RMA 10-point scale. On that scale, 1 through 6 are passed and 7 through 10 are criticized, with 7 being special mention, 8 substandard, 9 doubtful, and 10 loss. And after peaking in 2009, we saw a long period of improvement, culminating in a service low of 5.56% in June of 2018. And as recently as March 2020, we're just slightly above that. But we've seen 100 basis point jumps in May and June and currently sit at 8.5% as banks reacted to the uncertainty caused by business closures due to COVID-19. The industries with the current highest level of criticized loans are the following. Mining, oil, and gas sit at 26%. Accommodation and food are at 22%. Transportation, and this is airlines and water cruise lines, are at 21%. Arts, entertainment, recreation are at 18%. And 45 retail department stores are at 17%. So on the next slide, we're going to take one last look at C&I, and this is loan growth. And what we've done here is excluding PPP loans, loan balances at most banks have decreased. On this chart, we compared the loan outstandings for each bank October versus September and tagged each change as an increase if it was up greater than 1%, which you see in the green. Flat if the change was between a +1 and a -1 in the yellow. And then negative, less than 1%, as a decrease shown in the red. And only 7% of our RAS banks had a positive change this month. And the recent results of the Fed survey would indicate that this will continue as demand is low and banks are hesitant to relax standards and lend money. So let's move on to CRE. And just as a quick definition, in RAS, CRE loans are to borrowers where at least 51% of the repayment will come from rental or leasing income. And these are loans that you'll frequently refer to as investor owned. So here's our performance trend. Again, the non-accruals and the past dues. And after reaching service lows for delinquencies in mid-2019, and then for non-accruals in March of 2020, the performance of the CRE loans has deteriorated significantly. Delinquencies similar to what we saw with C&I have been extremely volatile, and for October 2020, at 0.68%, it's almost double September's 0.36%. Non-accruals increased to 0.84% and are now getting close to levels we last saw in 2015. And October's rate is triple what we had at the start of the virus in March of 0.28%. So let's continue on the next 2 slides with a little more detail on performance by property. Let's look at short-term delinquency levels for the top 8 property types. And by top, I mean the highest loan balances. And I don't think anyone is going to be surprised by the high level here you see for lodging. The problems there dwarf issues in every other property type and have skyrocketed to just below 7% for October. Then the only other property types that saw any increase in short-term delinquencies were mixed use, which tripled to more than 0.36%, and a very small increase for office. That being said, the real story here is the deterioration of lodging. Next page. So when we look at non-accruals for the top 8 property types, we see a little bit more action. 7 of the 8 October non-accrual rates are higher than September's, and multifamily is the only type that dropped. Again, lodging dominates here, just as it did for delinquencies, and is now at 1.6%, which is double what we see for retail, which jumped this month to 0.8% from 0.3%. We also saw significant increases for industrial properties. And this was a bit of surprise given the surge in e-commerce purchases recently, and something that we've made a note to keep track of. Next page. So here we want to measure credit quality by detailing the trend in criticized loans. Again, so very similar to what we did with C&I. And as these numbers increase, credit quality decreases. So going left to right, you see the dramatic improvement in CRE as criticized loans shrank from over 30% in 2010 to just 2.11% in March of 2020, just as the virus started. Now, post-COVID-19, the percent criticized has jumped in 5 out of the 7 months and is now at 8.71%, with most of that being tagged as special mention and a smaller proportion in the yellow as substandard. And the property type with the largest balance of special mention loans is lodging, almost double what we saw for multifamily. And lodging is about 10 times higher than the next type for substandard. So obviously there's tremendous problems going on in the lodging property type. Next page. So if you think back to the C&I growth, the red column, which is a decrease in outstandings, was the predominant result. So, but for CRE, it's not great news, but it's not as bad as C&I. C&I balances are basically staying steady, but as we move into the winter months, I expect this might move a little more towards the red. And the last page, so a quick summary. That's October 2020. What we saw was for delinquencies and non-accruals for both C&I and CRE increased. The credit quality for each was about the same as September, and the balances for C&I dropped, but were steady for CRE. So now I'll hand it back and open it up for questions.
Thanks, Tom. We do have a question here. Could you provide some flavor around why the syndication's participations have such a large increase in past due?
Sure. So if you go back to the chart that had delinquencies by industry, Renee, if you would for a second. One more. There we go. So, whoops, there you go. A lot of the participations, when we took a look at what they were in these markets that were all, you see the big spikes in red. So utilities, manufacturing, the management numbers are almost all participations, the professional and scientific. So it just happens to be that the industries that are having problems tend to be larger loans that are often syndicated or participated out across the board in terms of industries, and that's why you're seeing that jump.
Okay, Tom, our next question. Does lodging include Airbnb and similar services, or is that covered in residential?
So that lodging is not part, Airbnb is not part of that. That's in the, that would be in the C&I world under the real estate codes that are, I think it's NAICS 53 in there.
Okay, our next question. What in the data do you find most surprising or perplexing? Any sense of what the regulators are most focused on? And if you were in charge, how would you target stimulus? So a couple questions there, Tom.
So where to start with this one? In terms, I think, of what I find most surprising is, and obviously we have the delinquency chart up here, but if you look at the non-accrual by industry chart, if you could pull that up, that one. What has surprised me, and until you really start to think about it, is you can see that only a handful of industries have really been hit. Oil and gas, manufacturing, the management and the admin, the arts and the accommodation. So and the reason I say it surprises me is when we took a look at this same chart back in 2018 at the Great Recession, every industry had been hit during the Great Recession. No industry escaped any issues. But here, there's only, and what's going on today, it's very limited. And the term I've heard is a K-shaped recovery. So some industries are going to recover faster and others at the bottom of the K won't. This is what surprised me the most. It's only a handful of industries. In terms of the regulators, what they're focused on, I know Doug Skinner is on the line. He's an ex-regulator. He might be able to answer that a little bit better. And what would I target in terms of stimulus? I mean, I think this chart sort of spells it out. So Doug, I don't know if you had a comment or want to comment on what's happening with regulators.
Doug, you're on mute. Well, you know what, Tom, I'm not sure what Doug might be having an issue. So how about we do have another question and we can maybe circle back to Doug. Do you have a view on possibility for negative interest rates for US dollars?
Unfortunately, again, Doug is the best one to answer that. Oh, there
hey,
he
Tom,
is.
can you hear me?
Yeah,
we can hear you now.
All right, sorry about that. So I got that last one. As far as a view on negative interest rates, I think what I would do is refer you to the public statements from the U.S. Federal Reserve, and the chairman there, Jay Powell, has been pretty consistent for going on probably a couple years now that they're not convinced that there's any real positive effects of utilizing negative interest rates, and that they still have other levers, monetary policy levers that they can employ if need be. So again, I think they've been pretty clear that they're not at all convinced of the benefits of negative interest rates. Toward that end, you've also probably seen they've been very vocally supportive of additional stimulus, which I think Bridget mentioned something right at the top of the program. There's no question that the stimulus has suppressed credit conditions so far, and the ability of the Congress to pass additional stimulus is certainly going to affect the shape of the recovery. So I think there's other areas outside of negative interest rates that they're focused on at this time.
Thanks, Doug. We have an additional question here. What exactly is included in the 55 management sector?
So 55 management is one of those catch-all industry codes. Within that, there's a section for bank holding companies, but the majority of the companies in there are just classified as holding companies, which, from what I've been able to gather in looking at the names and researching those, a lot of them are funds. I'm surprised that they're not in 52, but they're like funds management companies or venture capital type firms that are making a lot of investments. And I think that's why, and the investments they're making are highly leveraged transactions and things that would have marginal credit quality. And I think that's why you're seeing such a large increase in non-accruals.
Okay, we have another question here. As you mentioned, troubled lending is in a relatively few segments of the economy. Do you expect this to expand more broadly?
Tom, I can talk about that.
Sure.
So one of the things that you should have seen from looking at Tom's charts is that the COVID event has really affected different parts of the economy differently. There's been some parts that have really been largely unaffected, like housing and financial services. I think there was a report just this week on U.S. housing starts, and those numbers are fantastic. Then you have another kind of part of the economy that was hurt by the initial lockdowns. So maybe something like the automobile industry, which is obviously really large and has a lot of parts to it. But once the lockdowns were lifted, those areas of the economy bounced back really quickly. And then the other part you have is the most vulnerable, I guess, is the ones that have been hurt by social distancing. So things like entertainment, travel, hospitality. So a lot of service-oriented parts of our economy are still really deeply depressed and are not going to recover until there's vaccines and acceptance and confidence returns. So they represent about 40% of consumer spending, so they're significant. But the other way you could look at it is about 60% of the economy is actually doing pretty well. So right now, a lot of it, I think, hinges on if there's going to be additional stimulus, right? Because you're already seeing, I think there's 9 or 10 states that have started to roll back reopenings, and people are obviously getting nervous about that. Is there going to be more stimulus? So I think what happens over the next as you change administrations and see if there's additional funding is going to tell a lot, because as Tom showed you in the numbers. The size and the magnitude of the stimulus, there's no question that it suppressed credit from deteriorating further, as well as these regulatory supported deferral programs had a major effect, and they're all kind of they're all either been rolled back or on pause. So I think that's kind of where we are right now.
Thanks, Doug. We have another question here in regards to NAICS Code 21. How much of it is COVID related versus other factors suppressing oil and gas prices?
So this is I think we're on the right chart to answer that question. So if you look at the blue line here for 20 mining oil and gas, we were already at 3% back in December. And that was taking into account the long-term effects from the energy crisis, 16 and 17. There was an article in Wall Street Journal talking about Exxon and their ability to cover their dividends and payouts, as well as CapEx, and they said they needed oil prices to be in the $50 to $60 range. So oil and gas was already hurting to begin with. And then you layer COVID on top of that, and people stop driving to work, stop driving for vacations, and you can see the spike. So I would think the majority of this spike that you see in the red is due to COVID, probably at least half of it. Whereas the industry was having issues beforehand, and COVID's only exacerbated those issues.
Thanks, Tom. Another question that just came in is, where are the airlines?
48 transportation, and you can see that they did not go up very much. And I think some of that, one of the things we saw in RAS starting in about 2018 is a number of banks started what we're calling de-risking, and they began to get rid of some of the riskier pieces of their portfolio, and airlines were one of the things to go.
While you have this chart up, Tom, I think another thing that's probably worth pointing out for context is, so this data is from commercial banks, insured depository institutions, and they have substantially reduced their exposure to energy over the last 5 years. So it's bad, but they're they're far more diversified than they were 5 years ago when they had that 2014-15 event. So yeah, so while there's some issues there, and they're largely in this, oil field services and E&P, spaces, by and large, most of the high risk stuff is moved outside to the shadow banking arena.
Thanks, Doug. Thanks, Tom. It looks like we're winding down on the questions. I don't see any more coming in. I would like to remind everybody that we have recorded this session, so we'll be sending you an email with a link so that you can download the presentation materials as well as listen to the recording and share with colleagues. And I have nothing else. Bridget, I don't know if you have anything else you would like to say before we end?
Yeah, I would. This was really, really rich, interesting information, and appreciate Tom, your, walking us through it. Doug, Sean, your comments. I think it's been a great webinar, and I know that everybody is going to be studying these materials. So, maybe we can schedule a subsequent event to ask more questions and see if I won't hold you to predictions, but if some of your comments hold true. So thank you. Really appreciate your taking the time to be with us today.
Thank you as well, and everybody have a great day.
Thanks, everyone.
Thank you.
Much appreciated.
Thank you.